In this video, I'm going to show you the best types of fair value gaps to use when you trade. It's going to help you differentiate low probability versus high probability setups. One of the utmost important things in the market is knowing what fair value gap to use. So here's a little secret trick on what fair value gaps I like to use. Okay, so when you're a beginning ICT student, okay, you obviously learn about fair value gaps through diagrams, models, videos, whatever. And if I were to go on Google right now and type in FVG ICT, so I just typed it in Google, and I go to images, the one thing that stands out to me here, okay, in all these diagrams, is a very obvious singular fair value gap. You can see like right here, very obvious. It's kind of big. It's very known. You can see it with your naked eye, and it's very obvious. All right. So how do I go about using that fair value gap in the market? Well, here's what I do, right? So by using this fair value gap, I mean the fair value gap that's obvious, singular. Okay, so let me show you an example of a fair value gap you theoretically is going to be worse versus theoretically going to be better. So let's say we have a leg of price. Okay, so let me just draw a couple legs of price. So let's say we have a couple green candles, whatever, and that's that. Okay, so let's say you have 4 green candles. And in these sequence of green candles, we get like 3 fair value gaps in a row. Okay, so let's say we get a fair value gap here. Let's say we get a fair value gap here. Okay, and let's say there's a fair value gap up here. Okay, now is this obvious? Like, how do you know which one to use? Well, that's the thing, you don't. So let's say I encountered this situation in a setup where there's 3 fair value gaps in a row. Okay, now when I'm encountering this situation, okay, I am actually going to pass up this opportunity because it's not obvious enough. There needs to be one singular FVG that's obvious. Okay, so I'm just going to delete these. Now let's say we have the same leg and price, but let's say there's not a fair value gap up here. Let's say this wick actually gets closed like this. So now there's a lack of a fair value gap here, and let's say there's not one down here and not one up here. Now, this is a little more obvious. It's singular, so that's the one I'm going to use. Immediately, I see a really good example. All right, really good example. So we kind of dump a little bit here. To me, in the naked eye, there's not really any obvious fair value gaps in here. This is a bad example of fair value gap. So here and here, because there's kind of 2 of them. They're kind of cluttered. They're not obvious, and that's that. But it's not until we get the next couple candles we get an obvious fair value gap. All right. If you tell your friend to go learn ICT concepts, do you think they're going to notice these 2 first, or do you think they're going to notice this one first? Definitely this one. So this is the one I'm going to use, whether it be for an inverse fair value gap or a fair value gap going with bias in general. Okay. Here's another bad one. Not really obvious to the naked eye. Not really something I'd be interested in. Okay. Here's 2 more. Not really interested in these. Okay. Why am I not interested in these? Because there's 2 of them clumped together. It's not obvious. It doesn't look like this one where it's one singular obvious fair value gap. So in this example here, why do we chop around so much in this? Like, why do we not straight respect these? Because it's too many variables to play with, and it's not obvious at all. Okay, you want it to be a singular obvious gap that you're going to use. As you all know, I only use inverse fair value gaps. And recently, I made a full free PDF of inverse fair value gap rating setups that I use to rate my own setups A through C. So if you want to check that out, just click the first link in the description. It's completely free and hopefully should help you. So if I just go to the previous day, okay, the first gap I notice on my chart immediately, it just stands right out to me, is this one right here. Okay, knowing this gap is relatively low, okay, in a discount array, I know that because this is obvious, because it's in discount, it's going to be more usable, okay, because of how obvious it is. That's all it is, okay? It's very obvious. Now you can see the one above actually ends up failing, but does it truly fail? No, because this is not the entry. The entry should have been down here, right? This is just maybe a pyramid, or maybe you trail your stop, whatever. But this is the obvious one. It stands right out to me. There's not a lot of fair value gaps along with it or go along with it. And this is just the obvious fair value gap. Okay, same thing in these here. So we have a fair value gap here, and this is actually used as an inverse. But why would you maybe use this? Well, it's singular. It's very obvious. There's not multiple clumped on each other. Okay, same with this one right here. Very singular. It's obvious. It's not clumped on each other. So this is the fair value gap I'm personally interested in. Now, when I go to this price as a whole, do you see anything in the circle that I have drawn here? Anything that looks remotely close to what this looks like and this looks like? No, there's nothing obvious that's going to stand out to you right away. I'm always thinking in the mind of like, if I were talking to my friend who just started learning fair value gaps, what will they notice here? They definitely notice this one, they notice this one, and maybe this one. Okay, so those are the ones I'd be interested in using, whether it be for an inverse fair value gap or a fair value gap in general. Same thing with this one. This one's a little bigger, but it's obvious. That's the key part. It's obvious. Okay, down here, I would not use this. It's not obvious. It doesn't stand out to the naked eye, and it's just not something I'd be interested in. Okay, so you can kind of see you got these lot more obvious fair value gaps. So this one, this is actually a balanced price range. Okay, you can see in this example right here, it's a bearish one lined up with a bullish one, so I probably used it, and it's pretty obvious to the naked eye. This one as well. This one is pretty obvious to the naked eye. It doesn't actually get tapped into, but it's something I'd use because of how obvious it is. Okay, so when you're taking a setup, make sure it's an obvious fair value gap. Think about it in terms of if you were teaching your friend, would he see this fair value gap? That's kind of what I always think about when I go to take a fair value gap. And a lot of people overlook this. And ICT draws these one tick fair value gaps out, and they end up working, but you got to realize that's all hindsight, and he probably knows to draw on liquidity, and he has much more experience. But if you can dedicate yourself to just waiting for these obvious fair value gaps, you're going to be much better off in the long run, because it's going to be more of a light bulb moment and light bulb setup for you because of how obvious the fair value gap is. As you all know, I only use inverse fair value gaps, and recently I made a full free PDF of inverse fair value gap rating setups that I use to rate my own setups A through C. So if you want to check that out, just click the first link in the description. It's completely free and hopefully should help you.